And good morning, everybody. Happy Friday. Welcome into this week's long-form episode on Mining Stock Daily. Trevor Hall here, your host, and we've got a great episode in here. We've had him on a handful of times before, but Michael Howell of Cross Border Capital returns to the podcast to talk all things global liquidity as the stock market and major indices remain elevated at all-time highs, along with the cryptos and gold. I would say even had a pretty nice week. But we're going to talk about liquidity, and this might be the most concerning I've ever heard Mike in the last couple of years he's been on the podcast. And so it's really we run a number of different scenarios talking about U.S. bond market, the Chinese economy, and the bond market, and really what does it mean to inflate a debt away. So a lot of great topics in conversation with Michael Howell. Cross Border Capital is a global research group focused on monitoring credit liquidity conditions and capital flows. So everybody usually just kind of shuts up and listens to Mike whenever he talks. So glad to have him on. Special thank you to Arizona Sonoran Copper, Visa Silver, and Minera Alamos for their continued support of the podcast. And if you wouldn't mind, hit that like and subscribe on the podcast network you receive Mining Stock Daily on. And we're still having some issues with Apple Podcasts. They keep telling me that's fixed, but I don't think it's fixed. So you may try to refresh your app and you should get the latest episodes of MSD there. All right, everybody, let's jump into this fantastic conversation with Michael Howell. All right, everybody, happy Friday. Welcome back into Mining Stock Daily in this week's long-form episode, and it's going to be an important one as we begin to wrap up 2024 this week and next week. And just by mere chance, I had to scramble to find a new location for this interview as the power department decided to change the power lines in my neighborhood and said they're going to shut off the electricity all day. So I did scramble and find a place, and by good measure I needed to, because Michael Howell decided to give us some of his time this week to talk all things global liquidity, talking markets, and we're going to talk precious metals and what it's saying, and probably dabble a little bit into Bitcoin as well. But there's a number of different avenues I want to take this conversation, Mike. I missed you last week in London. Sorry we couldn't make that happen. That was my fault. I should have reached out to you earlier, but I'm glad we could make this happen this week. Listen, there's speculation rampant going on right now in the market as the major indices, most of the major indices, are hovering around those all-time highs, but some of the industrials have started to come off a little bit. I just want to get your sense. Let's talk general liquidity on global terms, what you're seeing, because I got to say it, you're a little bit more concerned now with liquidity, at least when the communication's coming out of your Twitter feed, that I've seen you be in the last couple of years.
Yeah, absolutely, Trevor. Well, first of all, it's good to be here. I'm pleased you're plugged in again, so that's great news. In terms of the outlook for 2025, I mean, our view has been for some time now, it's going to be tougher than this year. I mean, we've been very bullish on markets, as you know, for the last 2 years, both through 23 and 24. We turned bullish when the liquidity cycle picked up from October of 2022, and that was triggered. I mean, the first event that really launched that change was the Liz Truss budget in the UK, the debacle that basically caused the UK Bank of England to change tack, and then shortly afterwards we had the problems in the US with SVB, bank default, etc., and the Federal Reserve became a lot more accommodative. And what they've been doing, they being the US Treasury and the Federal Reserve over the last few months, is undertaking what we've characterized as a not QE and a not yield curve control. And those two concepts basically tell us that there's been secretive easing going on. So the headlines may be, okay, they're still doing QT, supposedly, quantitative tightening, but actually in reality markets have been fed by liquidity, and that's why markets have gone up. Risk assets, as you rightly say, are at all-time highs. The problem going into 2025 is there's going to be, first of all, we've had 2 years of this stimulus now, and it's sort of beginning to fade. There are questions over maybe what Scott Bessent is going to do at Treasury, given the fact he's been very critical both of Fed Chairman Powell and of what Janet's been doing. I mean, in a interview some months ago, he labelled Powell as unpatriotic, and he said that Janet Yellen was basically running a policy fit for an emerging market, not the United States. So one would suggest that he's going to change things, but notwithstanding, there are clearly uncertainties about the course of US liquidity next year. And the other bogey that I think markets have got to try and deal with is this so-called maturity wall, which is fast approaching. Now, the maturity wall is basically the fact that a lot of debt is coming up for rollover, really beginning middle of 2025. It hits peak 26, 27. But that was really debt that was turned out during an era of very low interest rates, basically back during the COVID emergency. And corporations and governments, for that matter, basically took the opportunity to basically refinance into, in 5 years, 6 years forward, basically at very low rates. But that's now coming up for renewal in the next 1 to 2 years. And that's really a feature that will dampen liquidity or use liquidity, absorb liquidity in markets that otherwise would be used for risk assets. So, one's got to be, let's say, cognizant of that fact and maybe open-minded to what the effects could be. So what we need is central banks to remain with the taps fully open to accommodate this. The problem and the reason I cited is that this has been a common reason for financial crises in the past. Now, what I can do is just to demonstrate that with maybe a couple of slides, if I can put those up. And I'm going to sort of maybe push through to the key ones. This chart that you can see in front of you is a measure of the ratio between advanced economies debts. This is government debts, so all public debts plus private debts, including households, corporates. And what it shows is the ratio of that to liquidity. Take that as global liquidity, world debt to global liquidity. Pretty approximately, that's what it's measuring. If you look at that chart, there is very compelling mean reversion of that ratio at a level of just over 2 times. So debt 2 times the pool of liquidity. So what this is really saying is what we've really got to be thinking about is not this so-called debt GDP ratio that it's very fashionable to talk about. I don't think that means anything at all, to be perfectly truthful. What really matters is your ability to refinance debt, where liquidity is really the critical factor. And what this chart is saying is that there is mean reversion around a ratio of 210%, 2.1 times. If you get significantly above that, and the annotations on the chart spell that out, you get refinancing crises. And if you're significantly below that dotted line, you get asset bubbles. Now, we're in a big asset bubble now, in case people haven't noticed. But one of the reasons for that, there's been abundant liquidity relative to the amount of debt that's coming forward, coming back to market. Now, the way that I've treated debt here is that debt has been adjusted for the maturity profile. So it takes into account the timing of the maturity wall. And what this basically is saying is that we've had this gap for several years now where there's been a lot of liquidity, courtesy of generous central banks, courtesy of the COVID emergency. And what you've had is a terming out of debt, which has pushed the maturity wall back into 26, 27 or thereabouts. But if you look at that line, it's beginning to move back to normal. So we're not in the territory where you get financial crises for sure, but clearly we're a lot closer than we were 1 or 2 years ago. And that's the thing that we've got to bear in mind. Any slip in these ratios and you could get into dangerous territory. And that's clearly one of the concerns that we've got. Now, the other point that I think that I'd like to make is that if you go back to this chart, which is looking at the global liquidity cycle, focusing here again on the advanced economies, it looks like the global liquidity cycle is, first of all, on track. The black line is showing our index, which is measuring liquidity momentum across something like 90 economies worldwide. And the dotted line is a sine wave that we put on top of that to demonstrate the regularity of cycles. I always have to give a sort of or fess up here that this is not a cheat because we actually put that sine wave on back in year 2000, 25 years ago, and we just extrapolated it forward. So what you see is what you get, and it's lining up pretty well right now. It looks as if that cycle is going to peak out around late 2025, that's for sure. So liquidity is going in. This is not, a call to get out of markets. It's really a recognition of the fact that what we've got is a liquidity cycle that is maturing, and with it, markets are maturing. And what we've got to remember is that as that liquidity feeds into investment markets, asset prices rise, as they always do. Sometimes they get ahead of themselves, but generally they keep pace with that liquidity pool. Now, just to spell out where we are right now, this chart is looking at the level of global liquidity measured in trillions of dollars on the left-hand scale. And the orange line is the market value of gold and Bitcoin, or actually all cryptocurrencies to be truthful, but it's dominated by Bitcoin. And what you see here is the orange line, which generally keeps pace with the black line, has kind of overshot. And this is not actually just true of Bitcoin and gold, the traditional monetary hedges. It's also true of other assets, Wall Street, NASDAQ, etc. You name it. A lot of these asset markets have been fueled by liquidity. So even though you may be getting that black line moving upwards, what we've done is investors have kind of got a bit ahead of that. So I think we've got to be cognizant of that fact. This is not time to say, look, let's pile out of markets. Strategically, we still like risk assets, but tactically, you might say perhaps it's a time for a pause or something of a pullback. And I think gold has already had that pullback. Crypto, we're kind of waiting nervously for that to occur.
That's a very interesting chart, and I'm glad you shared that. I didn't expect to see this, but I haven't seen much of the correlation crypto and gold together with liquidity and kind of expectations with markets. But that divergence is quite interesting. Just kind of curious, what is the allocation if you look at that crypto plus gold? Is there a ratio between, if you predominantly say Bitcoin with gold, that represents this elevated high?
Yeah, right now as we speak, it's about 10% Bitcoin crypto and 90% gold. So gold dominates that.
Oh, wow.
For sure.
Interesting. I guess maybe my bias precedes me, because I would, given the big run in crypto we've had recently, I would have thought it would be the other way around, or at least maybe.
Well, it's catching up fast.
Yeah, absolutely. I want to talk about this debt wall a little bit here, Michael, and just kind of curious and provide a little bit of context of what we're coming up to. And I guess my follow-up question with this debt wall you mentioned, kind of running into 2026, I think, is this due to a lot of the issuance of short-term treasuries by Janet Yellen over the last couple of years?
Not specifically, but it's clearly a factor that we've got to take into account. I mean, that's important. The reason that Scott Bessent called Janet, a finance minister of an emerging market is exactly that she's basically pushed a lot of funding through the very short-term markets. And, bill issuance is now up to 22% of total US debt. The guideline that people have been operating on for a long time has really been between 15 and 20%. Now, I accept the fact fully that it's been a lot higher than that in the past, but that isn't necessarily a benchmark. The problem that you get is that if you do a lot of funding at the short end of the market through bills, and just bear in mind that a bill is a US government security with a maturity of up to 1 year, it doesn't pay a coupon. Basically, it's you buy it at below par and it's redeemed at par. So it's it's deemed a bill. It's been bills and actually as well very short dated government coupon bonds that Janet's been issuing a lot of. The average maturity of the issuance calendar has dropped significantly. In coupons, it's down by at least a year and a quarter over the last 18 months. So this is quite a pronounced drop. And the reason it's important is that, number one, the Treasury is hostage to short-term interest rate movements. Clearly, if you're funding at the long end of the market, you're terming out your debt, it's less of a problem. What Scott Bessent, to be accurate, is facing in 2025 is something like about 30% of the total stock of US debt has to be refinanced. And the average interest rate on the debt, existing debt, is 2.8%. So if they're going to refinance, the interest bill alone is going to jump by about 20% from the 1 trillion we are now, even assuming no change in rates. So this is one of the problems that Janet has basically caused by front loading. There's a second problem.
Sorry,
So the second,
go ahead. Sorry.
go on.
Well, my follow up question, just because obviously I'm not a bond expert by any means, but I'm just curious. What is the solution to tackle that problem that is in front of us?
Well, that therein lies a very interesting point. There isn't an immediate one as far as I can see. But let me just say
Okay.
the second problem first, or before I answer that. The second problem is that who buys that debt? The agents in the economy that tend to buy that debt are banks or credit providers, because they tend to like bills and short-dated debt for the simple reason that duration matches liabilities like bank deposits. A bank deposit can fly away pretty quickly. One's got an expectation it may last a few months or maybe a year or maybe 2 years. But you don't want to buy a 30-year bond against that bank deposit. You want to buy a short-term bill or a short-dated coupon, and therefore the banks tend to like those instruments. Now the problem is that if the banks are buying short-dated debt, they're effectively monetizing the government deficit. So Milton Friedman will be turning in his grave here, because the US government is basically selling its debt increasingly to banks and credit providers, monetizing, rather than selling to long-term coupons to long-term institutions, which is a funding decision, not a monetization. So we know that monetization is inflationary, and that's really one of the things that one's got to be conscious of. Up to recently, or up to now, one would say, without necessarily making any projections, most of that increase, that inflationary monetization, has gone into monetary inflation, not high street inflation. Although clearly there's been a recent legacy of high street inflation, but going forward there may be more of a problem. I'll come back to that. But let me just answer the question about what can Scott Bessent do.
Mm-hmm.
He could change the funding structure. He could say immediately that he's going to start to fund at the long end again. He's going to start reintroducing coupons, and that's possible. The only problem is that reduces liquidity in the markets, because that's going to absorb liquidity that would otherwise be used for risk asset purchases. So it's a negative for the liquidity cycle in that regard. Now, I think that if you look at the practicalities here, if you did that, it would spook the markets significantly. It would not only raise bond yields, in other words, push up term premium in the bond markets, but it would also unsettle the equity market, because liquidity is effectively coming out of the markets. And we know that his master, Donald Trump, basically views Wall Street as probably his one solid economic indicator. So what he doesn't want is a collapsing stock market. Now, or certainly not a collapsing stock market through his own design.
Well, it's not just
Well.
Donald Trump, Michael. I mean, it's the general population. When you have more people invested in risk assets in the stock market than any other time in history, it's not just President-elect Donald Trump that is, wanting to keep the party going. It's a majority of every one of the taxpayers in the U.S.
Absolutely, but what I'm saying is that Trump probably is making that decision, so he's the guy who's pulling the trigger. So I think it's kind of unlikely they'll do that. And I think basically the legacy of Janet, which for 2 years has been quite a clever policy, the trouble is that that's really poisoning the future, because it really does limit what Scott Bessent can do practically. I mean, he clearly wants to stop this. It's not good funding practice in the long term. You want to term out your debt as much as possible, and you want to basically issue at long durations. That's ideal. Unfortunately, we've gone the other way.
Yeah. It's interesting. So you had mentioned in some previous notes that obviously the U.S. stock market is the most important market in the world, but China's bond market is the most important bond market in the world. And so let's pivot here and talk about that dynamic, which is interesting to have, because I just saw a headline this morning that President Xi will be attending President Trump's inauguration in January. I mean, Donald Trump might be one of the biggest trolls in the world right now, just because I know everybody's going to be turning over in the grave. But it is pretty interesting given the economic dynamic and obviously the powers of both trading partners and seeing this kind of taking place. But let's talk about China's bond market, maybe China in general, because this is a big talking point that you've been sharing with your followers that people would need to be paying very close attention to, and obviously they continue to try to stimulate their economy for the better part of the year.
Yeah, but I think I mean, you raise a really important point with Z, wanting to visit Trump at the first opportunity. I mean, just look at Prime Minister Trudeau got on a plane immediately to see Trump. Look at what Trump did in Europe in the last week when he visited Notre Dame for the reopening of Notre Dame. Basically, European leaders were paying homage to him like an emperor. I mean, this is phenomenal. I mean, after bad-mouthing Trump for most of the last 4 years, these guys are now getting on their knees, principally. So, the power that Trump wields is absolutely remarkable here. People are listening to what he's doing, and that's a significant point. I mean, I've never seen that in a leader in my lifetime in the same way. So it's maybe it's because he's unpredictable, but hey, it seems to be working.
Yeah.
Now, in terms of let's get back to your point about the Chinese bond market. The issue is that what I'm really trying to say is that I think that if you look at Wall Street, this is the first cycle I've ever seen where US stocks have been treated by investors worldwide as the world market. Okay, that's I've never seen that happen before. So if you're buying US equities, it's basically a decision to invest in world equities, and that's as I say, the first instance. If you look at the Chinese bond market, what I'm trying to say is not necessarily that the US Treasury market is unimportant. Clearly, that's not true. But what I'm saying from a signaling point of view, the Chinese bond market is critical because the Chinese economy is so enormous and it dovetails so significantly right across the Asian region and actually throughout the world. So if the Chinese, I mean, the old story they used to say, if the US economy sneezes, we all catch pneumonia. This is getting more and more true about the Chinese economy because of its the elephant in the room. And the bond market is the barometer of the economy. Why have you got bond yields in China skidding below 2%? I think actually latest figure is below 1.9% as of last night. So this is a significant factor, and it seems as if Chinese bond yields or bond prices are going in the different direction to every other bond market worldwide. And why is that? Because the Chinese economy is in such a parlous state. Now, the irony in this whole process is that what you've got here is, I think, an unstable equilibrium. And the unstable equilibrium is that what's happening is that whenever China's trade surplus goes up, the yuan doesn't strengthen, the US dollar strengthens. That's not what the textbooks should be saying. But the reason it's occurring is that most of Chinese trade, or a very significant proportion of Chinese trade, either directly or indirectly, is dollar-based. Okay, so it's a little bit like saying, well, okay, if the Chinese trade surplus goes up, it's a little bit like California selling more exports. Okay, it's beneficial to the dollar. Now, the problem that is, if you sort of think this through, is that the Chinese are targeting, behind the scenes, but they've got this notional target of the yuan against the US dollar. So if the Chinese trade surplus goes up and the US dollar goes up, they've got to struggle and fight to keep the yuan level with the dollar. So they tighten. So then they basically push the Chinese economy more into recession. There's more impetus to basically slow import growth, and there's more impetus to actually bolster export sales because that's where the demand is. So what you get is a rising trade surplus, and you go through the vicious circle loop once again. So this is an unstable equilibrium that needs to be broken. And as far as I can see, the only way that you break that, ultimately, is either that the Chinese decide to devalue significantly the yuan. Now, that's what they need to do. This is not anything about Chinese goods being competitive or uncompetitive. Basically, trade balances or imbalances all about flow of funds and nothing to do really with currencies. And what China needs to do is to basically get its real exchange rate down a lot lower. Now, they can either do that by devaluing the nominal exchange rate, or what they do is they let asset prices or goods prices fall. And the market is doing that for them as we speak, because it's basically pushing both the downward pressure on the nominal exchange rate and on goods prices and on asset prices. And that will go on until we break that loop. So number one is that China actually forces through a devaluation. They could do it indirectly by a massive fiscal boost, which the banks monetize, which is being talked about, but it's only being talked about, no one's doing anything. Or the other option is the US does something where it basically takes pressure off by devaluing the US dollar. Now, that may well be the trump card, excuse the pun, but that may be the trump card that the administration uses with China on top of this tariff threat as well. Trump has tremendous bargaining power with a firm dollar because it really ups the ante significantly. Strong dollar puts huge pressure on the rest of the world. It's the wrecking ball in the world economy. Everyone suffers. Just look at emerging market currencies now. Now, the deal that might come out, I don't know what the deal could be, but there will need to be a deal. And in a book I wrote some years ago called Capital Wars, the conclusion I said in that book was that America and China are too important, okay? They've got to find some way of working together because the world economy can't survive if they're attacking each other. They've got to find some way of working together. Maybe there needs to be lines drawn, clearer lines drawn, whatever it may be. But maybe part of that process is getting more Chinese production in mainland USA. In other words, getting factories situated in the US. That could be a deal that would appeal to Trump. I don't know. But at least if there is any military hostility, then at least the US could actually take control of those manufacturing plants. That could be one option. And this deal may involve getting the dollar down. Now, if you think this through, if the Chinese want to devalue and the US is accepting that, maybe the reality is that the yuan dollar cross rate stays pretty much where it is. And actually what happens is the dollar and the yuan both devalue simultaneously against gold.
Yeah, I was going to ask if both of those situations could happen in tandem.
Now, interestingly, one of my colleagues has just finished an extensive project looking at statistical analysis of the Chinese gold market. And what seems to be the case is that China is driving the world gold price more and more. That's what the evidence say. There's clear, if you're any statistical geeks out there, there is clear Granger causality in terms of what China's doing statistically.
Yeah.
Now that's statistics, but hey, it seems like that's what's going on.
Well, and there's a little bit of speculation as to the timing of it all over the last, probably, I would say 2 years. It sounded like they took a pause on buying gold during the summer, but I think recently, in the last month or two, they've been active purchasers of the yellow metal once again. But I guess my follow-up question is as to why, and that's the more speculative question, I guess. A lot of people maybe go back, well, with maybe the development of a potential BRICS currency and gold being applicable to that valuation whenever it does get off the ground, if it does get off the ground. And the other one is really just for insurance with some of the things we've been talking about, global liquidity concerns, economic uncertainty in the future. So maybe let me ask you that. I mean, knowing that the reason or the question why remains a little bit speculative, what is your sense of why China would be buying so much gold?
Well, I think you more or less answered the question. I mean, one is as an alternative to the US dollar, that's for sure. There is no other alternative to the dollar in practice in financial markets. No one really trusts the euro, particularly if you look at what's going on in France, or even for that matter in Germany. And if you look at other currencies, I mean, the British pound, too small. Swiss franc, just way too small. Singapore dollar, nice idea, but way too small. It's the dollar is the only asset class that the Chinese can invest their whopping great surplus in. They can play around with gold. Gold is a useful, alternative asset. But, to be perfectly truthful, they've got no choice but to invest in dollars, or they get their trade surplus down dramatically, and that's not an easy ask in the near term. So the US dollar is not going to go away. That's absolutely for certain. And the whole idea of a BRICS currency, I think, is a fanciful one anyway. But gold is a sensible alternative for them to build up. We know that China is redenominating a lot of her trade in yuan. I'll come quietly on that. It's a fact. But the reality is that if you take an example like Saudi Arabia, who is being paid for oil in yuan, they're not holding yuan, they're converting those yuan as fast as they can back into dollars. So de facto, this is a dollar trade still. So, the reality is that China has to either build up gold or it has to build up It has to build up dollars, and that's what we're seeing. Now, how do they operate? What are they doing in terms of buying gold? I think that if China needs to get rid of its debt problem, what China needs to do is to devalue its paper money. That's the reality here. Okay, every other occurrence of a major debt bubble worldwide has required a devaluation of paper money, wherever you look. Okay, now what do you devalue against? Now I think most people are thinking, well, okay, all China needs to do is to devalue against the US dollar, but that's not really the answer. What they need to do is to devalue in monetary terms against gold, and that's what's going on. If you look at the data over the course of the last, let me think, the last 5 years or so, what you've seen is a dramatic devaluation of the Chinese yuan against gold, and you've seen of about 60% or so, but you've seen barely a 7% devaluation against the US dollar. So, this is what's going on before our eyes. They're actually getting out of their debt deflation progressively by devaluing against gold. Now, it may well be, and this is a sort of head-scratching moment, to say, well, okay, perhaps the yuan gold market is more liquid than the dollar yuan market, because the dollar yuan market is tightly controlled. And it may well be that actually what's happening is that China is operating on the yuan gold price. It's accumulating gold. We know that it's buying up gold, getting the gold price, real gold price up. It's slated to print money and in the future and maybe print more money. So the yuan will devalue significantly against gold. But it's then stopping, if you like, the effect of that monetization coming through on the dollar yuan cross rate by maybe manipulating the paper currency exchange rate market, in various ways. Now, I've got no particular proof of that, but I think that broadly what seems to be going on. So my train of thought is to say, if China continues down this track and the US allows the dollar to devalue against gold simultaneously, they can keep this agreed level for the yuan US dollar cross at circa where we are now, 7.5 or thereabouts, in that range, and see the gold price moving up significantly. The plain fact is, whichever way this cuts, if you've got a big debt problem in the world economy, which we have, you've got to devalue paper money against gold, and that's what ultimately we're going to see. I mean, my benchmark statement to people is, look, since year 2000, the stock of US Treasury debt, which is now $36 trillion, has gone up 8 times. So it was about 4 and a bit trillion in year 2000. Gone up 8 times. Price of gold has gone up 8.75 times since year 2000. It tracks debt. It tracks monetization. And that's really the thing to think about. And if you go back to this, to the presentation I was showing, and I'll focus on this chart again that I put up. What's really important in this chart is to draw the distinction between the black line and the dotted line that's at the bottom. Now, the black line is global liquidity, and the rise in global liquidity over that period is what we describe as monetary inflation. Okay, it's basically pumping liquidity or money through the system, devaluing your paper money. The dotted line is high street inflation. So that's saying, well, okay, what's US CPI done over that same time frame? And as you can see from the chart, I mean, if you just gauge the scale that's on the right hand side, you could say over that period broadly, the price level has doubled, whereas looking at what's happened to global liquidity has gone up 18 times. Monetary inflation has easily outpaced high street inflation. Gold is not a high street inflation hedge, so people get muddled by the fact that sometimes inflation comes down and the gold price goes up and vice versa. Gold is a monetary inflation hedge, and what we've been seeing is huge monetary inflation. Now, why is there a big difference between the dotted line and the black line? Simply because high street prices involve other things. They involve technology change. They involve things like oil prices. They involve things like taxes. They involve things like cheap Chinese goods. All these factors affect the high street, as well as monetary factors. If you roll forward and you say, well, okay, monetary inflation is going to continue over the medium term because, frankly, with the commitments in welfare spending and social security that all governments of all stripes worldwide have committed to, the only way politicians can afford this is to basically kick the can down the road and issue more debt and monetize it. So you're going to get more monetary inflation come what will, whatever the good offices of Elon Musk and Doge and whatever. It's going to happen. They can trim at the edges, but the trends are still there. And what that means is you've got monetary inflation. What's going to happen to high street inflation? Well, you tell me what's going to happen to cheap Chinese goods, technological breakthroughs, the price of oil, and taxation. And I would say basically none of those factors is going to be significantly negative on the high street price level. So you've got to expect in the future that high street inflation matches, in a way it didn't in the last 30, 40 years, the rise in monetary inflation. So we're going to get more inflation in the high street.
I'm wondering, and I apologize if this is a very naive question, but actually I don't apologize about it, Michael, because I think it needs some clarification. Something for myself, I've done enough of these podcasts over the years to know a great deal about macroeconomics, but I'm a journalist at heart, and so I need to ask these questions, especially when there's something I don't quite understand. And I will actually admit that when when we talk about inflation and we talk about the rise of global debt, and people say, well, one of the solutions is to inflate the debt away. And I kind of get it, but I don't understand the practicality of it. And if I can't be the only one listening to this or even watching that's heard this and be like, oh, that doesn't make sense. How do you actually inflate a debt away? Can you succinctly just kind of simplify what that actually looks like in layman's terms for, Joe Six-Pack plumber who's working at 8 to 5?
Yeah, because actually what you've asked is the $64,000 question. It's the key question that no one answers. Is that why is it that people say you've got to have debt, falling in real terms against the price level? So in other words, people say, well, okay, let's try and get debt growth below inflation growth, or let's try and get the debt to GDP ratio lower. What does that really mean?
Yeah.
Okay, it doesn't necessarily make the debt disappear. It may mean from an economic point of view it's more affordable generally, but it may well be that the people that are indebted are not the ones that are getting increasing incomes or are seeing rising prices. What you've got to change is the balance between creditors and debtors in the economy. And that's the principal thing. So actually what you say is asking a naive question. Actually, it's the key question to ask. And that's why I think that the debt GDP ratio, which is very fashionable to talk about, is completely meaningless. Well, not completely, but largely meaningless. What you've got to think about is debt has to be refinanced, not paid back. Spoiler alert, debt is never paid back. It's just rolled over. So what you've got to have is the facilities in the economy to roll the debt over. And that means you've got to have liquidity, balance sheet capacity, in other words, within the financial system. And it's the debt GDP ratio, it's the debt liquidity ratio, which is the important factor. As this chart says, this is where the equilibrium is. If you look at debt GDP ratios, they're all over the place. Okay, so in Japan it's 400%. In Germany, public debt is sort of 60-70% of GDP. If you look at the southern European economies, in Europe it's 130%. If you look at Central Europe and Eastern Europe, it's about 50 or 60%. So you've got these whopping divergences all over the place. What does it really mean? I don't know. But debt to liquidity is really the meaningful statistic. So what you've asked is actually a very profound and significant point.
Well, I appreciate that. Because it really has just kind of boggled my mind for the last couple of years, to be quite honest with you. And it also, I'm glad we kind of brought this up because it also kind of comes into a topic about the incoming presidential administration, Trump 2.0, and really his kind of position on inflation. And you've been out there and you've actually called Trump 2.0 an inflationary hawk, which is quite interesting. Would love to really kind of break this down and not only we've understood. You've talked about the challenges in the bond market that they're going to have to try to tackle here in the first couple of months of the administration. But inflation continues to be sticky. The Federal Reserve is not hitting that 2% inflation target that they and their counterparts seem to be that they want to hit. In fact, inflation is not necessarily going away. And so maybe talk about why you feel Trump 2.0 is more hawkish for inflation than anything else.
Okay, well, let me just settle the point about inflation and what the Treasury is doing first, and then we'll get on to this policy map. What I argued, and I mentioned at the beginning of the program, is that what the Treasury and what Janet's been doing is what we loosely described as not yield curve control, yield curve control. So in a nutshell, what they're doing is rather than funding at the 10, 15, 20, 30-year tenor in the bond markets, they're funding it 1 year or less, or one or two, somewhere between 1 and 2 years. And what that does is it changes the liquidity dynamics of the system. Now, if you broadly define liquidity of an asset as the size of that asset divided by its duration, you get the idea. Because if they change the duration, in other words, the maturity of the asset, if it's that ratio between the asset size and duration, if you reduce the duration, you actually improve the liquidity of the asset, right? So what they've done by doing this is actually by stealth injected liquidity into the US system. And, if we had to estimate that over the last year, that may have added something like somewhere between 10 and 15 trillion dollars to liquidity. So this has been really meaningful, okay? Now, what that has done as well is it's basically skewed the bond market and it's reduced bond yields significantly. And what that has meant is that the US 10-year Treasury is probably trading about 100 basis points below where it should do. Now, how do we get that gauge? Look for comparison at other markets. Look at the corporate credit market or look at the mortgage-backed security market, and you can basically bootstrap what a true 10-year yield should be. And the true 10-year yield is, as I said, about 100 basis points higher than where it is. So it's nearer 5.25 than 4.25. Now, hold that thought and then say, well, okay, what's the one economic indicator that a lot of people look at which has completely derailed over the last 2 or 3 years? Answer the yield curve. Because an inverted yield curve has fooled everyone into thinking the economy is going into recession. But if you add 100 basis points back to the long end of the market, which takes out Janet's bias, right, you've got a positively sloped yield curve. Okay, it's not steep, very steep, but it's at least positive, and it's not flashing recession. Hold that thought again and say, well, okay, what does that mean for the tips market? Okay, so we've got tips which have got implied inflation running at just over 2%. So, hold one's hands up and say, fantastic. Chairman Powell has basically cracked this inflation thing. He's got inflation right down to target levels. Brilliant. Wrong answer. Because if you add 100 basis point back to the long end of the nominal market, you've actually got an inflation rate which is running nearer at 3.5% on average over the next 10 years, not 2. So basically, the situation is showing that the US economy is growing and it's got an inflationary backdrop. Okay, so that's where we start. So I think that needs to be taken into account when you're really evaluating things. There is more inflation in the system, but I think everyone intuitively knows that, because if you go out to the shopping malls, you know that prices are not doing what the statisticians tell you. Now, on to what Scott Bessent is doing, and he focuses on inflation. Listen to recent speeches. He basically says, why is Biden going to lose? Why did he lose? It's the inflation. It's inflation, stupid. It's that point. Okay, turning around the Clinton point about it's the economy, stupid. It's inflation, stupid. This is the thing that really derailed the Democrats. They didn't tackle inflation. He also cites Japan. Why did the Japanese change their leader? Because of the inflation problem. And this is a key thing. So his point is you've got to control inflation. And we've got an emerging, not a serious, but an emerging inflation problem in the West, okay, as a legacy of all this liquidity. If you look at this map here that I've sketched out, this is what I think if there is sort of joined up thinking going on, or certainly from my perspective, what they're trying to do. So point number one, if you look at these things sequentially, point number one is the deregulation, downsizing of government, right? And then you've got the tariff thing. That should possibly, I mean, I'm not going to hang my head on this, it could possibly reduce the deficit, okay, possibly. But those two factors together are going to underpin the dollar, because what you're doing is you're effectively deregulating the US economy, and foreign money likes deregulation, and it will come into a more free enterprise structure. Dollar goes up, that contains inflation, keeps a lid on price increases, and lower inflation means that yields don't have to rise so much. That improves the funding background. And so what you've got here is a consistent picture. And that will allow, I think, Scott Bessent to basically extend the tenor of funding naturally without having to suddenly hit the brakes. And that's how I think this is going to evolve. But the dollar goes up. Now, if you look at the dollar, which is, I mentioned earlier on, which is the wrecking ball, and let's just look at two slides. One is this one, which is showing net inflows of money into the US economy. This is why Wall Street and risk assets have been so good, right? Money has come in. Let me give you three other examples of where this has occurred. Japan in the 1980s, emerging Asia in the mid-1990s, and China in the period after the global financial crisis. You saw exactly the same phenomenon. It ended badly, but it ended badly when the money came out. And the other thing that you get in association with that is a strong currency. Now, this is my preferred measure, which is the real trade-weighted dollar, which is data that you can get from the BIS in Basel. They provide this data monthly, and what it shows is the real trade-weighted dollar. What you can see by looking at real exchange rates is trends far more easily. And what I've done is tried to highlight what I think are the trends there, which is a long downtrend in the dollar, which ended around the time of the GFC, and the period since the GFC where the dollar has basically moved up in an uptrend. Point number one, that uptrend, recent uptrend, looks to me fairly solid. Okay, there's no evidence that that's about to crack. It looks pretty good. So the dollar has got upward momentum, and that's good for Wall Street and US assets. But think about the asymmetric response in terms of global liquidity to these different states, falling dollar and rising dollar. In a falling dollar environment, what you're going to get is the Federal Reserve trying to protect the markets much more than they might otherwise do. So in other words, there's money potentially draining out of US capital markets, and so the Federal Reserve comes in and eases policy, and therefore what you get is one big infusion into global liquidity. But foreign central banks don't like their currencies appreciating against the dollar, so they ease at the same time. So what you've got during the period of dollar weakness is very abundant global liquidity. If you've got a period where the dollar is rising, then you reach a situation where foreign central banks don't like their currencies going down against the dollar, so they tighten. So that detracts from global liquidity. And therefore, if you want global liquidity to go up, you've got to rely on the Federal Reserve, or by implication, the US Treasury through what Janet's doing in the not yield curve control. So basically what's happened here is that, US exceptionalism has been all about this rising dollar, because what it's allowed is the Federal Reserve to ease. Foreign central banks don't like their currency weakness, so they tighten. So the answer is that capital flows into the US, Federal Reserve adds liquidity, Treasury adds more liquidity, and you get this huge asset bubble. Now, did you see that in Japan? Absolutely. Did you see that in China? Absolutely. Did you see that in emerging Asia? Absolutely. Exactly the same pattern. So US exceptionalism is actually US dollar exceptionalism more than anything else. And that's really the reality of this. When is the bubble going to burst? When the dollar turns down and when capital flows exit. And that's, as far as I can see, not immediately. Are you going to get challenges to liquidity in the next 12 months? Sure, because of the maturity wall. but otherwise, it looks okay.
Well, and timing such a change is almost a fool's errand. And obviously I wasn't um, participating in markets during the rise of Japan in the 80s and 90s, and nor I just read Russell Napier about what happened in Asia, in Hong Kong in the 90s, Michael. But it sounds,
Huge capital inflows.
huge capital inflows, exactly. But you expect history to rhyme from time to time and understand cycles. And it's funny. Like, I'm glad we're having this conversation today, because I had mentioned to you prior to recording last week, while I was in London, I sat in and watched the Lehman trilogy on the stage, and that play presentation just follows the family through many cycles, from the 1840s on to its collapse in 2008. And so, you saw business and economic cycles play through this 3 hour play and performance. It was absolutely fascinating. I'd highly recommend anybody who's able to go watch that, because I think it's only got a few weeks left.
I've seen it. It's brilliant.
It's so good. And watching that, and then yesterday there's this great video that was put on YouTube called, like, "Have We Reached Max Stupid?" And it's really kind of about the rise of all these meme coins and the falls here immediately after, and really what's happening with MicroStrategy being way overvalued above its current Bitcoin holdings. It's just the speculative nature of where we're at in this cycle. I have to say, it has me concerned. And so it's humbling to understand where you're coming from, that you obviously see liquidity concerns in the midterm, but not necessarily something that's a great financial crisis type of situation that we've seen. I guess how old were we, about 15 years ago, but so I guess
not yet, but I mean, I draw the analogy that enjoy the party but dance near the door. I mean, things are changing, but you've got to know the exit when it comes. And if you look at let's take Japan. What crushed the Japanese market was inflation.
mm-hmm.
And I recall back in the late 1980s when I was in the markets, Maeno, who was the central bank governor, the equivalent of Jay Powell, basically said inflation in Japan is picking up, and we've got rising service sector inflation. And people looked at each other and thought, well, hang on, no one ever measures service sector inflation in Japan. And the fact that the consumer price index in Japan, if I recall, was dominated by the rice price, which was fixed. And so you didn't really get any evidence. But seeping around the corner, there was incipient inflation coming through, particularly in services, and they tightened and they burst the bubble. They went too far, obviously, with hindsight, but boy, did they burst it. And then if you look at emerging Asia, what happened in the mid-1990s was that there was this big splurge of capital. You got inflation. It wasn't that the central banks tightened in those instances. It was much more the fact that foreign investors saw these gaping trade deficits, because all that money that was going into these economies was fueling a consumer boom. And that was sucking in imports. Trade deficits were widening fast, and foreign investors got spooked back about the currency, the integrity of currencies, and pulled their money out, and that just caused a cascade effect through the economies. And then China, basically same phenomenon. China began to tighten after this big bubble that was blown up, both in real estate and in the markets around the middle of the last decade.
Yeah, it's just, you wonder when. Obviously, the U.S. markets and assets are the best place for money to go. It certainly feels like there's a lot of challenges to continue that momentum. And I think a lot of, I think with the election of Donald Trump, there was a lot of positive momentum that it'd be good for assets, good for the stock market, good for deregulation, good for business. And you almost wonder if that speculation's overdone, if it's too good. I'm hoping it.
Yeah, I mean, I think realistically, I'd be looking at gold. I think you'll make a lot of money out of gold, because if I'm correct, and it shows by the initiative of Z wanting to meet Trump quickly, they want to do a deal. Okay.
Yeah.
This is, dare I say, the Chinese leader kowtowing to Trump, what it would seem like. and they want to do a deal. And if that deal is along the lines that I would suggest, what you're going to see is a significant increase in the yuan gold price. And I think that will translate into a higher dollar gold price. Now, if that transpires and that enables the Chinese economy to get back on the tracks, then you're going to get resource stocks beginning to fly. And that could be, another leg up. But, that's something I think to wait and see. And let's not predict that, but it will be good to look.
Well, I mean, what's been fascinating is that gold's hovering above $2,700 US, US dollars per ounce, and the gold miners, per the GDX, are still kind of stuck in the mud. I mean, it's not even close to all-time highs. It's a head scratcher. All right, Mike, thanks so much for your time. I took up an entire hour, and I really can't thank you enough.
Pleasure.
You're a must follow. Your Substack, your Twitter feed, the book, which I read a couple years ago, continues to be a reference on my shelf for anything I need to kind of be refreshed at when it comes to global liquidity. I can't always look forward to these conversations, and we'll talk again soon here in 2025.
Great, Trevor. Look forward to it.
Thank you so much.
Thanks so much.
Happy holidays. Merry Christmas.
And to you, happy holidays.